Isn't it kind of strange that the rich people tend to become richer with every single crisis? So this was the most obvious during COVID. In COVID, everything crashed, many businesses had to shut down, and the billionaires after COVID were richer than ever before. They grew their wealth much more than the average. Now, why is that? Is there maybe something that we can learn from this? Is this just an unfair advantage? Or can we potentially learn something and apply to our own lives, that in case there is the next crisis, that we get out of this in a better way? Here's something that I believe most people do not have on their radar. They are betting everything just in one direction. And that is that the market is going up, that the economy is doing well, that everything is rosy. Think about this. Very likely, your income stream is positively tied to the economy. If the economy is crashing, there is a higher likelihood that you don't get the bonus, that you might get unemployed, that you don't get a raise year over year. There are some exceptions to this, right? There are some industries that benefit from economic crises, but most very profitable sectors, especially, let's say, the tech sector, it tends to suffer quite a bit during economic downturns. So your income stream and your ability to save is directly tied to the economy. But so are all of your investments. Very likely you have a 401k that goes up and down with the economy. Very likely you have property. They might also be correlated. During a crisis, people are unlikely going to buy houses. Maybe you've got a significant portion of your wealth tied up in a luxury car. And if there is a big crisis, probably if you want to sell that car, you will also not get any good price for this because nobody has any money. Let's say you're buying crypto for diversification. Now, Bitcoin crashes during an economic crisis as well. When liquidity is tight, then it will also get withdrawn from the crypto ecosystem, including Bitcoin. So what does this mean? When we're going down, everything in your life goes down with it. When it rains, then it pours for you. For the poor people, for the regular people, for the people that are not informed, they are suffering the most during an economic crisis. But the very rich people, they are a bit smarter. They know how to diversify well. They know how to actually buy the dip efficiently. You might not be able to buy the dip because you got unemployed, but the rich billionaires, they know what to do. Here's fundamentally what we want to do. We want to have hedges against a crisis. Most things are pro-cyclical, for example, property prices, but some things potentially are not. Let's say precious metals. Now, precious metals right now are very, very expensive, but still having a bit of net worth in precious metals makes sense. If you currently have a job in tech, for example, you could consider, could I maybe work on the side for a company as a side hustle that's maybe not so much impacted by an economic downturn? Maybe I could work for a business that even benefits when things are going down. Let's say a company that makes money when other companies foreclose, that takes advantage of liquidations. Rich people have investments that are not directly correlated to the market. They might be buying hedge funds, for example, that go long the market, that go short the market, that might actually make more return when things are crashing. Rich people are also able to lever up their positions as we crash. They can take their current assets and borrow against them and buy even more of it when things are on fire sale. A lot of takeovers, a lot of M&A transactions happen during times of economic crisis. Maybe some companies haven't been prepared properly for an economic downturn, they struggle, and then the big competition is just eating up all of those companies and the market consolidates. The rich, the billionaires, they become richer at the expense of most others. So we want to look at additional income streams that are not correlated with the general macroeconomic environment. We want to have investments that do the same thing, right? We want to buy precious metals. We want to potentially also have some fixed deposit. So that's okay, right? It's okay to hold some cash as long as it gives a bit of return as well and offsets the monetary debasement to a degree. Money debases by roughly 6.8% per annum. If you get 4 or 5% on your fixed deposit, you're offsetting at least the majority of the debasement. You can do this for a while as well. for a hedge. And it might also make sense to think about your consumption, right? Maybe it makes sense to buy things that are able to sell very easily during an economic downturn. If you want to liquidate some things, to maybe then buy the dip. Really, we want to find ways to effectively buy the dip, to be liquid when most people are not liquid. We want to be prepared for the crash. We do not know when the crash is coming, but it's pretty much certain that at some point in our lifetime, there will be another crash. It also makes sense to think about debt. So probably you don't want to have too much debt during good times, but if things are crashing, maybe it makes sense to buy that house during the property crisis and take a mortgage. Or maybe it makes sense to take a personal loan and pay this off over the next 2 or 3 years and buy the dip in Bitcoin or in the stock market or in a diversified portfolio of risk-on assets that crashed. Maybe it makes sense to lever up when nobody else has liquidity to then actually double down. If your income stream is safe enough, you can afford to take some leverage. But of course, debt is like fire, right? If we take too much debt, it's dangerous. It can burn down the house. If we take the right amount, we can cook with it. We can have additional value that we can extract from the market. So just play this out. Let's say we've got another COVID crash, or let's say we've got another global financial crisis, or let's say another .com crash. Whatever the next crash will be, what will you actually do in order to get more exposure to the market as prices decline? What's actually the call to action here? If we've got a plan that's prepared, we are much more likely to follow that plan. It's much better to have something prepared now than to try to come up with something during times of panic. So first of all, we can of course buy the dip with the cash that we have on hand. Then we can buy the dip with some debt, right? You might get a personal loan and you can buy all kinds of things, right? We don't want to bet everything on just one asset class. We can just increase our risk in general and then buy some stock ETFs, some gold, some Bitcoin, just some diversified portfolio that over the years is likely going to appreciate. We do this when times are depressed. We do this when opportunities arise. And I understand how some people might be against this, but when you think about this fundamentally, it's really not a problem. Many people take out a loan for a car, and cars depreciate by 20 to 30% per annum. Why would you take out a loan for something that goes down that much in value if you don't have to? Would it make much more sense to take out a loan for something that over the decades appreciates? Most people think it's terrible to buy stocks with borrowed money. But I think it's much more terrible to buy a car with borrowed money. And that's what's totally socially acceptable. But for some reason, buying stocks is not. I think the reason is simply because people don't know what they're doing when they're investing. They're not buying a diversified portfolio of various asset classes. They're just buying a single stock. And that single stock, maybe a stock that's hyped up, that might go down. But of course, you don't want to do this, especially when you deploy leverage. You want to buy something that has an extremely high likelihood of appreciating after the crisis again. Don't take debt for consumption, right? Don't take out debt for a car or for furniture or for vacation. That's all bad debt, right? We only want to take debt for investments, for comparatively safe investments if we can. And then with that diversified portfolio, we can also shift our risk over time. Right, so let's say we drop a little bit. So we buy the dip with cash. Then we drop a bit more. Then let's say we take out a personal loan to buy a bit of gold, a bit of stocks, etc., diversified. Let's say we drop even further. Then we can just increase the inherent leverage of our portfolio to get even more exposure. So let's say at the beginning we bought a lot of gold, maybe a bit of S&P 500 ETF, something like VOO. We are dropping further. What can we then do? We can sell some of the gold and buy VOO with it. We can sell some of the VOO and buy some QQQ with it. So we go up the risk curve, because if we crash, then the recovery will be more extreme for the more risk-on assets. So we can move from something less risky, like gold, to something more risky, as we crash further, like regular stocks, to something even more risky, like tech stocks, right? The Nasdaq 100, QQQ. So we can just go up the risk curve as we crash further and further, because the more we crash, the more likely it is that at some point we recover, and the more violently we will recover. So we want to double down and triple down and quadruple down as we crash further and further. We want to get more and more exposure as prices get cheaper. We want to buy something for low prices, and the lower the prices are, the more we want to buy. And so what's then the ultimate expression of absolute risk exposure? It's probably something like the 3x levered ETFs. Right? So if you have crashed further and further and further, and now the stock market is down, say, 70% from the all-time high, 80% from the all-time high, something we haven't seen for a while. But at those levels, it might make sense to actually buy a triple X ETF on the S&P 500 and then just ride this out for the very, very long term. Simply just adding more and more exposure over time. So that's the idea of buying the dip, right? We don't necessarily just buy the dip with our cash flows. We reshuffle our current assets to get more and more exposure. We increase our leverage to a certain degree that's still long-term healthy, right? We can still make the payments, but we want to be mentally prepared. We want to have some kind of a plan that we actually take proper advantage of a drop. We want to buy enough that we are content with the gains that we get with the recovery, that we don't tell ourselves, oh my God, I wish I had bought more. But we also don't want to buy that much that in case it continues to drop a bit further, that we get completely wiped out. Right? We want to find the right balance. Enough that we are satisfied, but not that much that it will completely wipe out our entire existence if things don't directly turn around. So the numbers are different for different people depending on how your cash flow situation is, how safe your cash flow is, how your cash flow is growing over time, etc. I think if you have a plan for a potential crisis right now, if you're setting something up, if you know I'm going to buy this ETF, if it drops further, I'm going to shuffle to that ETF, and then I'm going to go to the bank and get that kind of a loan, and I do this kind of contributions from my savings into that vehicle, etc. If you've got that plan laid out, then I think there's a very, very high likelihood that after the next crash, you will be in a much better position than before the crash. And so you're able to mimic what the very rich people are doing during every crash. Every crash and subsequent recovery is a capital concentration event. Money flows from the regular people that don't know how to play the game to the people that are prepared, to the people that take opportunity during times of crisis. If you got some value out of this video, feel free to give it a like. It will help the channel grow. Feel free to also check out the playlist. There's a playlist with videos like this directly on the channel. Just click on the channel link and go to playlist to the mindset and strategy videos. Thanks for watching. See you next time on YouTube, or potentially also see you in the premium membership. The link to premium should also pop up on the screen right now. Cheers.